140% of GameStop's entire public float had been sold short by January 2021. That single number is the whole story. Context first. Short selling means borrowing shares, selling them, and buying them back cheaper later. The profit is the gap. But when 140% of available shares are borrowed and sold, more shares short than actually exist, you have built a structural trap with no exit. Melvin Capital and other hedge funds had been shorting GameStop for months. The thesis was clean: physical game retail was dying. Then a Reddit forum called Wall Street Bets identified the 140% figure. They didn't just buy the stock. They bought call options, forcing market makers to purchase shares to hedge, a mechanism called a gamma squeeze layered inside the short squeeze. GME went from $20 to $483 in 3 weeks. Here is what the financial press missed. The trap wasn't sentiment, it was math. When a short position exceeds 100% of available float, covering requires buying shares that technically do not exist in sufficient quantity. Every buyer drives the price higher. Every higher price triggers margin calls. Every margin call forces more buying. The mechanism is self-reinforcing and structurally inescapable once it begins. Melvin Capital needed an emergency $2. Follow for more stories like this one.